Okay, we are back with Ajay Rajadhyashaka. He is head of fixed income strategy at Barclays Capital. And Ajay, I was talking about this earlier with Andy Cinco about this auction. I mean, does any of this have any impact at all? The demand we've seen today, any impact on the 10-year and the 30-year auction later this week?
At the margin, it's a positive, but honestly, the 10s and the 30s are being driven by very different factors right now. Most specifically, what the Fed plans to do at the June 24th FOMC meeting in terms of increasing or not the amount it's going to use to buy U.S. Treasuries. Right now, it's slated about $300 billion till the end of September. The hope that some participants have is that that amount rises because $300 billion clearly, in hindsight, hasn't been enough given how much Treasury yields have risen.
Right, they've risen, and of course, that affects the housing market and the mortgage rates. I mean, do you believe that the Fed, or if you were a betting man, I mean, do you believe that the Fed is going to increase that program?
It's a very difficult judgment call to make. On the one hand, you could argue that mortgage rates have risen about 100 basis points from their lows here. Mortgage rates keep rising. That means that at the margin, first-time home buyers say, okay, well, maybe I should wait a little before I decide to buy a house, which is not good news for the housing market. On the other hand, that same home buyer might be feeling better about his economic circumstances because the reason rates have risen is because the economy seems to have found some kind of a bottom. If it's turned around, if he feels better about his employment situation, if his stock portfolio is up, then that might be more of an offset. Absolutely, yes.
You would be a seller then on the longer end of the curve right now, right?
I would do nothing on the longer end of the curve unless you held a gun to my head, at which point I would probably end up being at the margin a buyer, just because we've risen as much as we have.
A buyer, really?
Yes.
Okay, because we had an article yesterday from John Brynolfson. We've interviewed him, the hedge fund manager, talking about how the longer end of the curve is the best short in the world right now.
I would not go so far as to say that. It's very easy to get caught up in what has happened over the last 2 to 3 months. Financial markets seem to have stabilized. The economy seems to have bottomed somewhat. But we just came off one of the worst 2-year recessions we've seen in a long time. It's not to say that the recession is by any means over. You don't know if there is a double dip waiting in the wings. I think investors in general are likely to be a lot more cautious. Not everyone is drinking the Kool-Aid at this point.
In the last, and also speaking about Kool-Aid, I mean, it seemed as if after the jobs report on Friday, everyone was drinking the Kool-Aid that the Fed was going to raise interest rates, let's say by the November meeting. What's changed in like the last 72 hours on that front?
What changed was simply the passage of time. People took, one step back, looked at the economy, looked at their portfolios, looked at how much rates had backed up, and a lot of them said in the front end, this is just silly. The Fed is not going to go anywhere in the next 6 months or so. In fact, it's a moot point whether the Fed does anything for the next 18 months. So I think that really is what has changed. It's just a passage of time. Once you get away from the initial frenzy, that's when you start to make decisions based on fundamentals rather than technicals.
Right. Okay, then Ajay, given all of that, looking at the yield curve, and where would you be buying right now in the bond market?
I would actually be a buyer at the front end, which is why I'm not surprised at the way that this auction has gone. Typically, front-end auctions over the last few months have actually gone well. The reason being the front end is driven by what the Fed does for the funds rate. And most people, like I said, still believe that the Fed is not going to do anything for a long time. So that, I think, is where value lies.
And overall, I mean, looking longer term, what is the bond market telling you about the inflation-deflation debate right now? I mean, where does it stand at this moment?
It's changed quite a bit over the last 3 to 4 months. 3-4 months ago, you could have made a reasonably strong argument that a deflationary spiral downwards was a realistic possibility. I think at this point, that argument at least has been laid to rest. So at this point, if you ask me whether I'm more worried about inflation or deflation, it is almost unequivocally inflation.
Okay. All right. We'll be watching that, of course, as always. Ajay, great to see you in person. Thanks so much for joining us. That was Ajay Rajadhyashaka of Barclays Capital talking about the just closed out Treasury auction of 3-year notes.